Bob has personally sold almost 1,900 buildings in New York for an aggregate value of $18 billion. Bob Knakal.
Thanks, Eggs. Morning, everybody. Glad to see so many of you here this morning. By a show of hands, how many people in the audience believe you have a really good handle on what's happening in investment sales today and where you think it'll be a year from now? Okay, I don't see any hands. I would have changed places with you in a second because for the first time in a long time, I really don't know where the heck the market is going. I know where it is today. I have some suspicions about where it might be headed, but it is more opaque today than I've ever seen it. And as Victor said, we're on the verge of having the longest economic expansion in the history of the United States. Why isn't the investment sales market here rip-roaring and doing great? Right? That's the question everybody's trying to answer today. There's a lot of fear in the market, skepticism, some optimism, some mixed signals, but where the heck are we going? That's what we're trying to figure out. But in order to figure out where we're going, I always like to take a look at where we've been and take a look at cycles. You know, if we look at the market, where the market has been, clearly 2014 and 2015 with a cyclical peak of activity. In 2014, there were more buildings sold in New York City than ever before in history by more than 10%. Over 5,500 buildings were sold. In 2015, we had over $80 billion in sales volume. That was an all-time record. So in actually the beginning of the fourth quarter of 2015, we started to feel some cracks in the market. That's when the market turned. So I believe that currently we're about 45 months into a correcting market in investment sales. And it started end of September of 15, beginning of October of 15. I remember that we had a couple of development sites that we were putting on the market. We had been working on the marketing books for a couple of months. And the beginning of October, Hags and I go into the client and say, look, I'm sorry to tell you this, but you missed the market. You're not going to be able to get the price we told you. And they're like, what are you talking about? And over a 2 to 3 week period, all the development sites that we had on the market that we were expecting $800 a foot for, bids were coming in at $650, $625, $675. And because of the number of sites we had on the market at any one time, we saw this happening throughout Manhattan, in the outer boroughs. And we knew the market had changed very tangibly. And that's one of the first signs, the first two market segments that get impacted when the market turns is land and hotels. Land, because land's indicative of what developers believe the market's going to be like 3-4 years from today when that product comes online. And hotels, because leases are only for one day. So those two markets shifted very tangibly. So in 2016, we believe that real values fell. But what happens when the market changes and real values fall? Sellers who have properties on the market don't like the bids they get, and they don't transact. So these arrows are very indicative of the beginning of a changing cycle where dollar volume falls, number of properties sold falls, but values still go up because you have a smaller sample of properties trading. Sellers who can get their price sell, sellers who don't get their price don't sell. That's what happens in 2016. But by 2017, values kind of caught up with what real value was, and we saw the numbers were down across the board. In 2018, things started to look a little better. We saw dollar volume increase. There was a feeling in the market that things were getting better. Number of properties sold didn't go up. They were about flat. Very, very impactful because dollar volume always moves before the number of properties sold do. So this was telling us, hey, the market's coming out of this. At this point in time, we were 39 months into this correction in the market. And we said, you know what, 18 is going to be a great year. Values will still have a little downward pressure, but because that volume is popping up, 19 is going to be great. So projected, and on 1/1/19, we said, well, dollar volume will continue to go up. Number of properties sold will go up. Property values in the first half of the year probably will still have some downward pressure, but by the second half of the year, values will be going up, and 2019 is going to be a great year. So what happened? Actually, first half of the year, we have dollar volume and properties sold down about a third from what they were last year. and there's downward pressure continuing to be exerted on property values. Not much. This correction has been relatively benign compared with past corrections, where property values today are down maybe high single digits, depending on property type, but on average about down single digits in this correction compared to 38% reduction from 2007 to 2010. And for those of you who were around during the S&L crisis in the early 90s, values dropped by 58% during that point in time. So as corrections go, this was relatively mild. If we look at the second half of the year, now we're projecting that values will stabilize by the end of the year, and it has to, because if you have job creation, Victor, what, 109 months in a row now? 109 months in a row of job creation. Nothing impacts the underlying fundamentals of real estate more than job creation. It drives every single sector in the marketplace. You can't have that much job creation and not have it impact our underlying fundamentals, and that's both nationally and in New York City. So we believe that in the second half of the year, property values will stabilize. We're probably still going to have downward pressure on dollar volume and number of properties sold. A lot of that has to do with the multifamily market. In our statistical sample of properties that we look at, there are 165,000 properties. 90,000 of those are multifamily buildings. And because of rent regulation renewal, we expect that there's going to be some downward pressure on values. When values drop, volume drops. That one sector alone will impact the broader market. But we do expect that values across the board are going to stabilize later this year. So that 2018, when volume of sales increased, that was a head fake, right? And we've had some head fakes in the market. Normally, when that dollar volume starts to increase, we say, oh, that's a great sign, market's going to turn around. There have been 3 other times that we've had these head fakes in the market: 1986, 2000, 2012, and just recently in 2018. But what was the cause of those head fakes? They were externalities, and the externalities were tax related. Market participants in commercial real estate are highly reactive to changes in tax policy. So we go to 86, that was tax reform of 86, tremendously impactful on the market. 2000, the market had that head fake because of the capital gains rate reduction in 1998. So what happened, because capital gains dropped from 28 to 20, we had a spike in sales in 1998. That reduced the number of sales that occurred in 1999, and then we had a spike which would have been the natural peak in that market, but for the capital gains tax reduction. So 2000, we had that same spike, and in 2012, we had the capital gains tax increase that was embedded in healthcare that was going to kick into place, and we had a big spike in 2012. So I'm sitting here thinking, well, what is the thing that really caused this head fake in 2018? And the only thing I could come up with, and it's a guess, is the Tax Cuts and Jobs Act of 2017, which was going to be effective January 1st of 18. So could it be that that created such a positive momentum with corporate America, that small, if you look at the expectation index for small businesses, it has been off the charts because of the tax cuts. But still, this doesn't really answer why we have this kind of malaise in the market to some degree today, and people are not as optimistic as the economic metrics would dictate.